In April of 2026, 3 out of every 4 cars sold in China were made by a Chinese company. Not Volkswagen, not Toyota, not General Motors. 3 years ago, that number would have sounded impossible. Today, it is the new normal. And it is about to become the new normal everywhere else, too. Made Detroit a symbol of industrial power. Everyone else, more or less, bought what those 3 built. That was the pecking order. It survived 2 oil shocks, a dozen recessions, and the rise of South Korea. It did not survive China. What is happening right now in the global auto industry is not a slow shift. It is a structural break. And the data behind it is almost hard to believe unless you sit with the numbers for a minute. So let's sit with them. Start with electric vehicles, because that is where this story actually begins. Chinese manufacturers produced more than 12 million electric cars in a single recent year, which works out to over 70% of all the electric vehicles built on the planet. 70%. Not 70% of China's cars. 70% of the entire world's electric vehicle output coming out of one country. No other nation is even in the same conversation. The United States is not close. Germany is not close. Japan, which once defined what a reliable, well-engineered car looked like, is not close either. And this is not a temporary spike caused by government subsidies that will fade next year. It is the result of more than a decade of deliberate, coordinated industrial strategy, where the Chinese government identified electric vehicles as the one place where it could leapfrog 100 years of Western and Japanese engine expertise, and then quietly built the entire supply chain needed to do it. Battery production, rare earth processing, motor manufacturing, software integration. All of it stacked vertically inside one country at a scale nobody else had built. The result is showing up in real time in the numbers coming out of China's domestic market. In April of 2026, new energy vehicles, meaning fully electric and plug-in hybrid cars combined, made up just over 53% of all new car sales inside China. That is up from under 48% the year before. In other words, more than half of the cars being bought in the world's largest auto market right now are not traditional gasoline cars anymore. That threshold, the moment where electric outsells gasoline, is a line that American and European planners assumed was still years away. China crossed it quietly, without much fanfare, sometime in the last 12 months. But the number that should really stop you is the 75% figure. 3 out of every 4 cars sold in China in April were Chinese brands, not joint ventures dressed up to look local, not foreign badges built with Chinese parts. Actual Chinese-owned brands, competing and winning against Volkswagen, against Toyota, against General Motors, on their own turf in the largest car market on the planet. For decades, foreign automakers treated China as their most important growth market, the place where they made the profits that funded research back home. That relationship has flipped. China's own companies are now the ones setting the pace, and the multinationals are the ones playing catch-up inside their own most important market. And it is worth pausing on why this happened at all, because it was not luck. When you look at how China built this advantage, the story starts underground, quite literally, with control over the raw materials that go into a battery. Lithium, cobalt, nickel, and especially the rare earth elements used in electric motors have been dominated by Chinese refining and processing capacity for years, long before most Western planners considered electric vehicles a serious threat to the existing order. While European and American policymakers debated emissions targets and consumer incentives, Chinese state-backed investment quietly locked up mining rights, built refining plants, and secured supply agreements across Africa, South America, and Southeast Asia. By the time the rest of the world woke up to how important battery supply chains were going to be, China already controlled most of the choke points. Take BYD, because it is the clearest single example of how fast this has moved. A few years ago, BYD was a battery company that also happened to make cars, mostly unknown outside China. Today, BYD sold more than 1 million fully electric and hybrid vehicles in a single year, and in that same year, it surpassed Tesla in pure electric vehicle sales for the first time in history. Tesla, the company that effectively created the modern electric vehicle category, the company whose founder became the most famous industrialist on the planet, was passed by a Chinese company that most Western consumers still cannot confidently name. And BYD is not stopping at China's borders. It is now selling meaningfully in Europe, in Southeast Asia, in Latin America, in markets where price-sensitive buyers are discovering that a well-built electric car from China costs a fraction of what a comparable European or American model costs, while offering comparable or better range and technology. Think about how strange that sentence would have sounded even 5 years ago. Tesla was not just a car company then. It was the definition of what an electric vehicle company was supposed to look like. The benchmark every analyst used, the stock every investor watched, the founder every rival automaker publicly measured itself against. And now in the single metric that matters most, pure electric vehicle sales, It has been overtaken by a company that started out making phone batteries. That is not incremental progress. That is a changing of the guard. This is the part that Western automakers did not see coming, or perhaps saw coming and simply could not respond to fast enough. Legacy car companies spent a century optimizing for internal combustion engines. That is an extraordinarily mature technology. There is very little performance or efficiency left to extract from a gasoline engine that has already been refined for 100 years. Electric vehicles are the opposite. They are still young technologies, batteries, motors, software, sensors, all of it improving rapidly year over year. And when a technology is young and improving quickly, the advantage goes to whoever is willing to move fastest and invest hardest, not to whoever has the deepest legacy expertise in the old way of doing things. China bet everything on being that fastest mover. It won that bet. There's also a generational comparison worth making here, because the world has actually seen something like this before, just never at this scale or this speed. When Japan rose to challenge American and European automakers in the 1970s and 80s, it took roughly 2 decades for Japanese brands to go from curiosity to serious global threat. And it took South Korea another 2 decades after that to repeat the trick with companies like Hyundai and Kia. Industry veterans who lived through both of those transitions describe the current Chinese rise as the fastest they have ever witnessed. A compression of what used to take 20 years into something closer to 5 or 6. The playbook is similar. Start with lower cost vehicles that outsiders dismiss as inferior, use the profits and the manufacturing experience to improve quality and design year after year, and eventually arrive at a point where the cars are no longer just cheaper, they are simply better. What is different this time is the speed. And the reason for that speed is electrification itself. Because internal combustion technology was so mature, there was no way to leapfrog it quickly. Electric vehicles reset the clock, and China sprinted through that opening before anyone else had even finished stretching. Now, here is where the story gets even bigger, because this is not just about China selling more cars inside China. This is about China becoming the world's dominant car exporter, and doing it at a pace that is reshaping trade flows on every continent. Through the first 5 months of 2026, China's auto exports hit a new record of roughly 930,000 vehicles, accounting for more than 35% of everything Chinese factories shipped. Read that again. More than a third of all vehicles coming out of Chinese factories are now headed overseas. Exports are no longer a side business for Chinese automakers, a way to soak up leftover factory capacity when domestic demand slows down. Exports have become one of the 2 central pillars of the entire industry, right alongside domestic sales. And there's a very simple reason why. Overseas markets are less brutally competitive than China's own domestic market, which is arguably the single most competitive car market in human history, with dozens of serious manufacturers fighting over margins that keep getting thinner every year. Selling abroad means less competition, stronger pricing power, and higher profit margins, all while keeping Chinese factories running at full capacity. It is, from a pure business logic standpoint, close to a perfect strategy. And it is not just cheap economy cars flooding into developing markets, although that is happening too. It is increasingly sophisticated vehicles, loaded with driver assistance technology, competitive range, and design that no longer looks like a copy of something European. The gap that used to exist, where Chinese cars were seen as cheaper but clearly inferior, has been closing so fast that in many segments it has effectively disappeared. Consider what buyers in Europe and Southeast Asia are actually experiencing on dealership lots right now. A shopper walking into a showroom in Thailand or Spain or Brazil is increasingly cross-shopping a Chinese electric vehicle against a European or Japanese one, and finding that the Chinese option comes with a bigger touchscreen, a longer warranty, comparable or better range, and a price tag that can be 20 or 30% lower for a similar size and category of vehicle. That is an almost impossible combination for a legacy automaker to compete with, because it is not just about undercutting on price, it is undercutting on price while matching or beating the technology. Consumers do not care about 100 years of brand heritage if the alternative gives them more car for meaningfully less money. That is exactly why European sales figures for Chinese brands have been climbing steadily, even in markets that were previously considered nearly impenetrable for Asian automakers outside of Japan and Korea. This export surge did not happen by accident, and it is not happening without the Chinese government paying very close attention to how it unfolds. Starting in January of 2026, Chinese companies and even foreign companies manufacturing inside China are now required to obtain export licenses before they can ship finished vehicles abroad. On the surface, that sounds like a restriction, something that should slow the export boom down. It is actually the opposite. That same instinct, control the pace, control the technology, control the narrative, shows up in another decision that barely made headlines outside the industry press, but which is genuinely a world first. As of January 1st of this year, China's market regulator introduced binding limits on how much energy an electric vehicle is allowed to consume. Not suggested targets, not voluntary guidelines. Binding limits backed by regulation. No other country on Earth has done this. What it means is that Beijing is deliberately forcing its own automakers to keep innovating on efficiency, to keep squeezing more range and performance out of every kilowatt hour of battery, rather than letting the industry settle into complacency now that it has already won the early stage of the electric vehicle race. It is central planning aimed directly at maintaining a technological lead, and it is working. If you want to see all of this converge in one place, look at what happened at the Beijing Auto Show in the spring of 2026. Industry analysts who walked the show floor described it as a strategic inflection point, the moment where it became undeniable that Chinese automakers and the suppliers around them are no longer trying to catch up to the rest of the world. They are actively setting the terms of competition that the rest of the world now has to respond to. The show's theme was, fittingly, the future of intelligence, built entirely around artificial intelligence integration, autonomous driving features, and smart cabin technology, categories where Chinese companies are now moving at a pace that Western automakers, weighed down by legacy engineering processes and slower regulatory environments, are struggling to match. Walk through what that actually looked like on the show floor. Cars demonstrating full self-parking without a driver touching a single control. Cabins that reconfigure themselves based on voice commands in natural conversational language, not the clunky menu-driven systems that have frustrated drivers for a decade. Driver assistance systems being bundled as a standard feature on relatively affordable models, rather than sold as an expensive add-on package reserved for luxury trims. In many respects, the show illustrated that the competitive battlefield in the auto industry has already moved beyond horsepower and handling and into something closer to a smartphone war. Where the winner is whoever ships the smartest, most connected, most rapidly updated software experience inside a moving vehicle. That is a battlefield where Chinese technology companies, many of which have deep experience building consumer electronics and mobile software at massive scale, have a natural advantage that traditional car engineers simply do not have. One detail from that show says more than almost any statistic could. Multinational automakers have spent the last few years talking publicly about deep localization, about truly embedding themselves in the Chinese market rather than just selling into it. But according to people who cover the industry closely, those localization stories often lag far behind the actual product timelines, the actual research spending, and the actual decision-making authority that these companies have handed over inside China. The slogans are moving faster than the organizations behind them. Meanwhile, Chinese automakers are building in exactly the opposite direction, taking everything they developed at home and pushing it outward into global markets. And this shift is no longer limited to the handful of flashy electric vehicle startups that got all the early media attention. It now includes established mainstream Chinese manufacturers moving in the same direction all at once. There is no better symbol of this reversal than what has happened to Volkswagen inside China. For decades, Volkswagen was practically synonymous with the Chinese car market. Its joint ventures were massive, its brand recognition was enormous, and China was arguably the single most important market in Volkswagen's entire global business. Today, Volkswagen's own European-designed electric vehicles, the cars it built, using its own European engineering and its own European design language, have essentially collapsed in Chinese sales. To remain relevant, Volkswagen has had to pivot towards something that would have been unthinkable a decade ago, selling cars that are designed by Chinese engineers using Chinese parts, built by Chinese partner companies, with the Volkswagen badge essentially licensed onto a vehicle that is Chinese in almost every meaningful sense except its name. The teacher has become the student inside its own former classroom. And Volkswagen is far from alone in that position. Across Germany specifically, the country most associated with automotive engineering excellence for the better part of a century, the ripple effects of this shift are already showing up outside the auto industry itself. Profit warnings, plant closures, and job cuts across the German auto sector have become almost routine news items. And in nearly every one of those stories, competition from Chinese manufacturers gets mentioned as part of the explanation. For a country whose economic identity is deeply tied to precision engineering and automotive exports, that is not a minor inconvenience. It is a direct challenge to part of the national economic model. What looks, from inside China, like justified pride in an industry finally reaching global leadership, looks from a German vantage point like an existential threat arriving faster than anyone had planned for. So, if China is winning this decisively, why doesn't it feel like the whole world has already adopted Chinese electric vehicles? Because right now, the world is splitting into two very different auto markets, and the divide is being drawn with tariffs instead of technology. Manufacturers raised its own tariffs on Chinese vehicles from somewhere between 15 and 20%, all the way up to 50% at the start of this year. On top of that, new tariffs have gone up on cars coming in from Europe, Japan, and South Korea as well, making North America an increasingly closed-off defensive market compared to almost everywhere else on the planet. Meanwhile, American automakers have been pulling back from electric vehicles rather than racing to compete with China on them. General Motors, Ford, and Stellantis have all scaled back their electric vehicle plans over the past year, taking financial write-downs on investments that are not paying off the way they hoped. Ford went as far as killing off the electric version of its best-selling truck, the F-150 Lightning, a vehicle that was supposed to be the flagship proof that American manufacturing could lead the electric transition. That single decision carried enormous symbolic weight, because the F-150 is not just any vehicle. It has been the best-selling truck in America for decades, a genuine cultural icon as much as a commercial product. Betting the electric transition on turning that specific truck into an electric success story was meant to prove that going electric did not require sacrificing anything distinctly American about how the country builds and drives its vehicles. When that bet quietly failed and the electric version was pulled from the lineup, it signaled something bigger than one canceled product. It signaled a retreat from the idea that Detroit could lead this transition on its own terms and its own timeline. Electric vehicle sales in the United States actually fell sharply after government incentives were pulled back at the end of 2025, and that decline hit Tesla especially hard, since Tesla generates the vast majority of its profit from the American market specifically. Picture it almost like a new kind of divide, similar in spirit to the one that used to split Europe during the Cold War. On one side of that divide sits a version of the auto industry racing ahead into an electric, software-driven, intelligent future, with genuinely excellent products available at prices that would have seemed impossible a few years ago. On the other side sits a market that has chosen to wall itself off from that future, protecting its existing manufacturers with tariffs, rather than pushing them to compete directly. The tariffs may protect jobs in the short term. What they do not do is stop the technology from advancing everywhere else in the world while North America stands still. And this is happening at the exact moment when China's growth engine is shifting from something that was mostly about domestic demand into something that is fundamentally global. For years, the story of China's car industry was a story about an enormous domestic market growing at a blistering pace. Vehicle sales are stepping in to fill that gap, becoming the primary source of new growth. China's car industry is no longer just a domestic story. It has become a globally integrated production and technology ecosystem, one that treats the rest of the world not as a bonus market, but as a core part of its long-term strategy. Step back and look at the full picture, and what you see is not a single change. It is at least 4 or 5 changes happening at once, all reinforcing each other. China now builds the overwhelming majority of the world's electric vehicles. Chinese brands have taken over the majority of sales inside their own domestic market, pushing out the multinational giants that used to dominate it. Exports have become a central pillar of the industry rather than an afterthought. The government is actively regulating and steering that export growth through licensing requirements, while simultaneously forcing continued innovation through binding efficiency standards that no other country has attempted. And an entire generation of Chinese automakers, led by companies like BYD, are no longer trying to imitate Western car companies. They are setting the pace that Western car companies are now scrambling to follow. None of this means the story is finished. There are real questions still hanging over China's auto industry. Questions about whether its domestic market has too many manufacturers chasing too few profitable sales, about whether some of that export growth will trigger further trade retaliation from countries beyond North America, about whether the current pace of expansion is sustainable once the easiest gains have already been captured. Some smaller Chinese manufacturers have already failed or been absorbed by larger rivals, a reminder that even inside China's booming industry, this is still a brutally competitive environment where not every company gets to survive the shakeout, no matter how fast the overall market is growing. Nothing in industry ever moves in a straight line forever, and China's own analysts are watching closely for signs of oversupply and slowing margins, even as the headline numbers keep climbing. But here is the thing that is easy to miss if you only look at the trade war headlines and the tariff numbers. Tariffs can slow down where Chinese cars are sold, they cannot slow down where Chinese technology is developed, and they certainly cannot force the rest of the world to stop watching what China figures out next. Every year that passes, with Chinese manufacturers producing the overwhelming majority of the world's electric vehicles, is another year where Chinese engineers, Chinese battery scientists, and Chinese software teams get better at doing exactly that, while American and European teams operating behind tariff walls have less pressure and less incentive to catch up at the same speed. Protection can buy time. It cannot buy back a technological lead once it has already been lost. History offers a fairly blunt lesson on this point. Tariffs and quotas slowed the arrival of Japanese cars into the American market back in the 1980s, too, and they did buy Detroit some breathing room in the short term. There's little reason to believe this round will play out any differently, except that the country doing the protecting this time is dealing with a competitor whose lead is growing across an even wider range of technologies, from batteries to software to autonomous driving, all at once. That is really what this moment represents. Not a single company beating another company, and not a single country simply outproducing its rivals for a year or two. It is the quiet, methodical end of a 100-year-old global order in the car industry, the one where America, Germany, and Japan decided what the rest of the world drove. That order is not ending with a dramatic collapse or a single headline event. It is ending the way these things usually end, gradually, then suddenly, through market share numbers creeping upward every single month, until one day people look up and realize the numbers have already crossed 75%, and there is no going back from a shift that large. The next time you see a car on the road that you do not recognize, a brand name that sounds unfamiliar, a badge you have never seen before, do not assume it is some obscure, minor player testing the waters in your market. There is a real chance you're looking at one of the companies that just rewrote the rules of an industry that shaped the last century of human life more than almost any other. The wall around North America might hold for now, but everywhere else on the planet, that wall does not exist, and the future of the car industry is already being built, sold, and driven, one Chinese vehicle at a time. Whether you view that as an exciting story of progress or an uncomfortable story about shifting global power probably depends on where you live and which industry pays your neighbors' salaries. But neither reaction changes the underlying fact sitting underneath all of it. For the first time in 100 years, the country setting the pace for the world's car industry is not the one that invented the automobile. And it is not the one that perfected mass production either. It is the one that looked at an entirely new technology, decided to build the whole supply chain behind it faster than anyone else on Earth, and simply refused to slow down. That decision is the real story here, far more than any single tariff, any single company, or any single quarter of sales numbers. And it is a decision that is still playing out, one car, one battery, and one export shipment at a time.